Okay, so I had two requests. I'm going to attack one of them in this video. It's not going to be a lot of charts and graphs and fancy stuff. It's just kind of a discussion. So the first question was, what would happen if, um, in any given economic situation, fiscal and monetary, what would be the combination of those two? And a lot of times the test will put that forth on the multiple choice section, not necessarily on the free response. But let me sort of attack um, what should be done, and then I'll go into the main weaknesses with fiscal policy. Okay, um, so if we go over here, now in any given economic situation, so what should happen is, and I'll try to write this down, in a recession. Now, in a demand driven recession. All right. So we're not talking about stagflation or cost push inflation or a supply shock. That there's really no fiscal or monetary solution to. You just kind of have to wait until the oil prices go down or whatever triggered it. You'll just have to wait. So just know that if it's a on the test, if they talk about a supply shock driving the economy into a recession with inflation, um, that there's really no fiscal or monetary. Any fiscal or monetary solution is driven on aggregate demand, and it will either make the situation worse with regard to inflation or make the situation worse with regard to recession. There's no way out of a supply shock. All right, you just have to kind of wait. In a demand-driven recession, where either people or businesses or aggregate demand is lagging for whatever reason, so monetary, let me try to write neatly because all right, that's about as neat as it gets. For monetary, if you're in a recession, you're doing the bull, the buy bonds, lower discount rate, lower reserve requirement. You're really doing expansionary, which we went over in prior videos. Fiscal, if if both entities choose to get involved, and that's the key. Monetary and fiscal could take a laissez-faire approach. It might be a mild recession. They might not say, all right, well, it's just, kind of a cold. We don't need to get involved. But if it's a severe enough recession and they choose to get involved and they don't do classical laissez-faire, monetary should enact expansionary policies. Buy bonds to expand the money supply and lower interest rates, lower the discount rate, lower the reserve requirement, which they very rarely use. They usually, the open market operation here is the one they used most of all. Fiscal should, if they choose to get involved, do expansionary as well. Cut personal income taxes and or corporate taxes, whichever one they choose, and increase government spending, or the G part of GDP. So those are the expansionary fiscal options. And on the test, you have to make a clear delineation between fiscal and monetary policies. That's like a huge chunk of the test. So what they should do is this. In inflation, monetary, okay, and I'll have the chart here. Monetary should calm the economy down. Calm down. So contractionary. Sell bonds, contract the money supply, raise interest rates, higher discount rate, higher reserve requirement, all geared towards increasing interest rates so that people, and the term you want to use on the test is interest sensitive expenditures, anything that you need to borrow money to purchase. All right, so if interest rates go up, you can't qualify for buying the house, you can't buy the car, you can't buy the fridge or the big ticket item that you have to borrow money for. So that's a huge chunk of C and I and a little bit of G. But people and businesses, they have to borrow money to buy things. And if interest rates go up, that's going to stop C&I from buying stuff. It's going to move aggregate demand back. And if aggregate demand comes back, that should control inflation, because that's the goal here, is inflation. Now, what fiscal should do is increase taxes to take money from people and get them to stop spending to control inflation, or decrease government spending, again, with the same goal, to decrease the amount of money they're injecting into the economy, decrease aggregate demand, control inflation. That's the ideal situation. This is what should happen. If you ever see a question saying, they don't do multiple choice, but which of the following should government and Fed do? This is what they should do. Just look for the things that are consistent. Now, in reality, there have been a lot of political circumstances where this is one of the main weaknesses of fiscal policy. Politicians don't run on an economic timeline. Politicians run on a political timeline. They care about getting reelected every 2 years, every 4 years, every 6 years, whatever the case may be. So in fiscal policy, one of the big weaknesses is that, indeed, they're more concerned with themselves and getting reelected than they are the economy necessarily, all right? So they're on a political, not a business cycle. That's one weakness. With that, they might do things for a political reason and not an economic reason, all right? And they might go counter to the business cycle. And this is, I'm just going to throw these two out there because they're the most recent examples of fiscal policy not doing what's economically correct. Back when Obama was first elected, 2008, 2009, 2010, the first 2 years of his term in office, the economy was terrible because of the Great Recession. The economy was awful. He was elected while that was happening, and the Democrats won in the first 2 years when they had control of the House and the Senate. They passed Keynesian expansionary measures. They passed stimulus packages and TARP bailouts and stuff like that. All textbook Keynes stuff to try to prop up a lagging economy. All right. When the Republicans took control of the House, and there but by a few votes, the Senate, they started in the middle of a recession. So you're talking 2010, it was pretty bad. The economy was not out of the woods at all. It had turned the corner in terms of GDP, but the state of the economy was awful. They couldn't agree on a budget, so they passed what's called the sequester. And the sequester was, all right, if the House and Senate can't agree on a budget and the president can't agree on a budget, well, then what we'll do is enact a series of government spending cuts. So everyone has to pay the price. Republicans, you got, they decided to cut some military funding, and Democrats, they decided to cut healthcare funding. So in that sequester, all right, so but mind you, in the middle of the Great Recession, Congress, for political reasons, because the Tea Party was at its peak and stuff like that, decided to cut government spending. Now, if you go back to the chart, if you're in a recession and you either raise taxes or cut government spending, that goes counter to what you should do. It will literally make the recession worse. All right. So that's not textbook. What you're supposed to do in a recession is cut government spending. I mean, that decreases decreases aggregate demand, makes the recession worse, in theory. Now, a couple years later, recently, all right, again, and the reason, to give fairness to the argument of why they did that, is they were worried about blowing up the deficit, and the debt, which is, as we went over in a prior video, that is a negative of Keynesian economic stimulus. Is if you cut taxes and increase government spending, it will increase the deficit, it will increase the debt. I mean, that's textbook, that's the crowding out effect. So that it will increase borrowing. Now, fast forward to recently, the economy was at 3 point something percent unemployment. The economy was great between 2012 and 2017, 2016. All right, the first couple years of the current administration. They decided, and it was Republican-controlled House and Senate at this time. They decided to pass tax cuts. Okay, again, political reasons. They got elected. Their constituents demanded it, so they passed what their constituents demanded, which was tax cuts. But economically, let's go back here. All right, economically, we were at either at or beyond full employment with 3.6%. It was to the point where the Fed was actually raising interest rates because they were worried about inflation a year back or a couple years back. They were starting to raise interest rates because at 3.6% unemployment, this is the big risk. Inflation is the big risk. So when inflation is the risk and the Fed is trying to cool down the economy, the Congress and the president enacted tax cuts, which would be expansionary, which would make any inflationary risks worse. Now, why would they do the opposite of what the economy wants? Well, once again, that's a weakness. And the last two, it just happens to be from the right. I don't want to make any, both political sides have done this. I mean, we have a long storied history, so I can guarantee you if you look far back enough, both sides are guilty of this. This is not a one side always messes up deal. Now, why would they do this? Because fiscal policy doesn't always do what's right. Now, the other thing is politically, no matter what side you're on, it's very hard. Let's say we have inflation. It's very hard politically to enact the contractionary fiscal options. All right. So if you enact let's give you a hypothetical. I'm a congressman. I'm a senator. I'm a president running for re-election. I raised your taxes because that's what was necessary. You're not going to get reelected. All right. So raising taxes, no one, left or right, likes increased taxes. So therefore, it makes this fiscal option, even if it's necessary, politically not ideal. Cut government spending, same thing. All those programs you guys want and you guys need, I made sure those are cut. So you can't get health care, you can't get unemployment, you can't get food, you can't get, you see what I'm saying? So that again is not politically ideal. So both options, people cutting those government programs they like or raising taxes, the entire contractionary fiscal arsenal over here is politically not expedient. It's very tough to get reelected. All right, so that is, now this is to the extent, this is such a big deal that the test has in the past had instances where they have had, I don't want to say, I don't know if it was recession or inflation, but let's say it was a recession. They said, suppose there is a recession and suppose Congress passes tax increase or government spending cuts in the middle of a recession. All right. And all my kids were confused because when they were trying to graph this, and I'll do a quick graph, they were trying to graph this and they graphed recession, and I'll do it really quick. All right. So they graphed a recession. All right. GDP, real GDP, price level. And they just, I'm going to do the quickie graph, AS, not the curved one, AD. They graphed LRAS, a recession. All right, and you always connect Y sub F, Y sub E, P sub E. So they graphed that, and then they went through their motions. They said, all right, either government spending cut or tax cut or tax increase. So tax increase, people have less money, so that decreases C, that decreases aggregate demand. Government spending cut, that decreases G, that decreases aggregate demand. And they kept thinking, they're like, wait, this doesn't make any sense because when I do the two things that the test asks for, it makes the recession worse. I don't think I'm doing this right because this isn't fixing what I was supposed to fix. This is making it worse. Exactly. That's the whole point of the test. That's how tricky this test gets, is they're testing a couple things. They're testing weaknesses of fiscal policy, that you're aware that sometimes people pass things for political reasons and not for economic reasons, and that fiscal policy often does what's counter to what's necessary um, economically. That is why, and that tests something about monetary policy. That is why the Fed is elected to, the Fed governors are appointed, not elected, misspoke there. Fed governors are appointed, which is a check on, we don't want Fed governors to be concerned about getting reelected and doing stuff. We want the Fed governors to be concerned with one thing and one thing only, whatever is necessary for the American economy, period. I shouldn't have to worry about either people or elected officials breathing down my neck because, oh, wow, it's August and I'm going to have to get elected soon. And you guys are raising interest rates. It happens all the time. That might be necessary. I can guarantee you that's what's necessary for the American economy. So Fed people, Fed governors are appointed to 14-year rotating terms. All right, 14 years. Think about House, 2 years, Senate, 6 years, President, 4 years, 14-year rotating terms. So they really wanted the Fed to be free of the system of checks and balances. Now they're appointed by the president and they're approved by the Senate. So there's a kind of small check and balance. If they're not happy with the way the Fed's going, president can appoint different Fed members. Senate can approve with the advice and consent clause different Fed people or not approve ones they're not happy with. But once they're in, they're free from the system of checks and balances for the most part. So there are often times when um, fiscal policy does not do what's right. And I've gone over in fiscal policy, there's a bunch of weaknesses. Crowding out effect, you can increase interest rates by accident. You borrow more when you're enacting expansionary policies. You do things on a political cycle, not a business cycle. It's very slow, those lags, and go back and look up your lags, time lag, the lags in terms of recognition lag, seeing that we don't know we're in a recession until we're 6 months into it. Congress doesn't work on a dime, nor is it designed to, so therefore operational lag takes a while to kick in, a timing lag, and then operationally, like especially tax cuts, they really don't kick in until April when you get your money back. And so between those three lags, recognitional lag, timing lag, and operational lag, those are also weaknesses of fiscal policy. So there's a lot of weaknesses of fiscal policy, but know what's ideal, what they're trying to do, what they should be trying to do, and know in reality there's a lot of weaknesses because the test will test both. Thank you. Good job, Krause University. Keep going. Study for this test.